Well, viewers, welcome back to Dukascopy TV today. Well, a lot has happened since the crash, but has it just been one big circle? Well, today I'm joined by Charles-Henry Monchau, and he is Head of Investments at EFG. Today we're going to have a look at the idea of a big rotation. So welcome to the studio today.
Thank you.
So since the outbreak of the crash, we've witnessed US Treasury bonds grow stronger and stronger. Now recently we've kind of seen a change in this due to more bullish sentiment about the economy and all these talks that the Eurozone may actually start to kind of heal. Now, what are you thinking in terms of this? Do you think we're going to see a change in the pattern since the crash?
Well, it's true that if you look over the last 15 years, bonds have been massively outperforming stocks. For instance, in the US, 10-year US Treasuries since 1998 have been outperforming the S&P 500 by more than 90%. And there have been obvious reasons for that. First, inflation has fallen, rates have fallen, and more recently with the euro crisis, investors have been hiding into US Treasuries. But one day, this period of outperformance of bonds versus stocks is likely to come to an end. Historically, when you have one asset class underperforming the other asset classes for a sustained period of time, at some point this asset class starts to rebound and outperform the other asset classes for a similar period of time. We see at least two good reasons for this fixed income outperformance to revert. The first one is that inflation and rates are unlikely to fall much further. That means that fixed income performance is likely to disappoint. And the second reason is if you look at relative valuations, stocks are much cheaper than bonds, which means that if we do see a pickup in economic growth, something we are anticipating, then this valuation gap is likely to narrow. So, are we going to see a period of performance of stocks compared to bonds? Yes, I think so at some point. As this period of performance already started, that's probable, but of course we cannot be 100% sure about something like this.
And recently we've witnessed strong inflows into equity mutual funds. Now, is this the start of a new trend?
Well, it's true that if we look at the numbers of January, inflows into equities mutual funds have been very good. And that's good news because over the last 2 or 3 years, equity mutual funds have seen very strong outflows. But just 2 remarks on that. First, it is January. It was January. So January is a very special month, which is historically favorable to inflows into mutual funds. So there is maybe kind of a seasonality effect there. And second remark is that January 2013 was also very strong in terms of inflows into bond mutual funds. So maybe what happened is a kind of window dressing by investment managers who had maybe too much cash in their portfolios and they needed to reinvest this cash rather than the start of a trend. We're seeing a lot of comments in the press and also by some strategies that we are the start of a big rotation. What is a big rotation? It's a huge move from fixed income funds into equity funds. We believe it's more a kind of a gentle rotation. In other words, we believe that this move is going to be progressive. Why is that? Because usually flows follow asset classes performance rather than the other way around. So in other words, we believe that this shift from fixed income funds into equity funds is going to be progressive because investors will progressively realize that fixed income outperformance periods has come to an end and that not equities are going to outperform. So we think it's going to be more progressive than something which is described as a big rotation.
Now this is from Bloomberg. February 4th, Japan's government pension investment fund is considering reducing its allocation to domestic bonds. The fund may increase holdings in EM stocks and alternative assets. Now, what do you think about this?
Well, there is lots of things going on in Japan currently. Since the arrival of a new government in December, we have seen a lot of news. But what I find interesting with this one is that that type of move is could happen potentially in other places of the world. Take the example of the US. If you look at the average allocation of pension funds in the US into equities over the last 6 years, it has fallen from 60% to less than 40%, while at the same time the average allocation to fixed income has moved from something like 27% to more than 40%. And that type of trends can be observed with US endowments, sovereign funds, and also Swiss pension funds. And at this level of yields, having such a high exposure to fixed income is just not sustainable. So what we believe is that over time we're going to see a shift back to equities from fixed income. Again, we think it's going to be progressive, it's going to be a gentle rotation as we meant before.
And finally, in terms of a big rotation, what else should we expect to see, such as actions from the central banks and their stance on things like quantitative easing?
Well, actually, actions by central bank is typically the kind of move that could accelerate this rotation from fixed income to equities. For instance, if at some point we see an abrupt end of quantitative easing by the US Federal Reserve, that could trigger a brutal rise of government yields, which means that investors might have to move more quickly than anticipated from fixed income funds into equities. On the other hand, we don't believe that an abrupt end to quantitative easing is likely. Why is that? Well, we believe that we are still in a deleveraging process in the US and the rest of the developed world. Economic growth is indeed reaccelerating, but it remains low. So we don't see why the Feds will take the market by surprise. So we don't believe that such a sudden shift is likely.
Now moving on to our Dukascopy question today. So if you had 1 million, where would you invest it in? Real estate, equity, bonds, gold, cash, oil? Where do you think is the best place to invest right now?
Well, we still live in a world full of uncertainties, so the way we invest our clients' money remains conservative. We keep a very high level of diversification into our clients' portfolios. But to answer directly to your questions, if we had one asset class to pick, it would definitely be equities. With that, we believe that the risk-reward for equities on a long-term basis is the most attractive. If you look, for instance, at the equity risk premium, which is the difference between earnings yields and the 10-year government bond yields, it is currently at its highest levels in 1975, which means that if you have a long-term time horizon, it is still a very good time to buy equities.
Thank you very much.
You're welcome.
Well, viewers, if you enjoyed this interview, then do click back to the website for many, many more like it. But for now, goodbye.